That's the Wall Street Station channel, and that's the great chance to boost our knowledge on economic cycles. So we'll cover where we may be heading next out of the data that is right coming in. So today we're gonna discover the correlation between crypto and macro. That's the very interesting concept you need to know. Many of crypto analysts think that crypto is absolutely separated financial asset, but it was maybe the clear narration back in 2010, 12, 13, when the financial asset class of crypto industry was very, very tiny. Right now, as it has enlarged, we cannot neglect the macro, and I will show you why. And at first, let's study the Hope matrix. And this graphic allows you to interpret which factors, starting from the left, express the recession in chronological order, from the factors that let us know about stagnation at the earliest, so-called leading indicators, to those that inform us about it at later date. So it means there are lagging. Among the others, there is NHB, so this all about the housing market is the one of the leading indicators. Afterwards, there is a consumer type of and business type of a sentiment. Right after, there is a jobs market, and at the end, there is a called CPI. So whenever you hear in the media that inflation is skyrocketing or just having a downward spiral, it means it is already the last indicator to watch. So why not to study the previous one? And if we just focus on that matrix, you will find the correlation with crypto as well. So that's very interesting. Therefore, we will, in order to analyze what impact macroeconomic indicators may have on the cryptocurrency sector, we'll analyze individual macro indicators starting from the left, going through the most important data, moving towards the right, ending with the inflation rate and GDP. So starting from scratch, let's look at inverted yield curve. So the inverted bond yield curve correlated with the period of interest rate increases has repeatedly informed bear markets in the past. There is high probability that this metric will also predict such a scenario in the coming time. Recession periods are marked by time periods starting from the moment the curve inverts, which may still occur ahead of us. At this point, the string is stretching, and its release may be correlated with a period of interest rate cuts. As we do know, we're already at a very high level in terms of interest rates, and it's over 5 points, and that's alike during every single latest recession. This very high interest rate is just putting in favor those companies that are not reliant on the lending conditions, whereas those small and medium cap companies will have supposed headwinds. High interest rates in turn have a negative impact on the cryptocurrency market, the development of which was and is largely dependent on the degree of availability of bank loans, when companies could take out debt on relatively favorable terms and invest in risky assets. The level of restrictiveness in granting loans is currently at a level that in 2001 and 2009 marked the specter of recession, and this still may not be the end. Speaking at a symposium in Jackson Hole, Federal Reserve Chairman Jerome Powell emphasized the potential need for the US Federal Reserve to introduce additional interest rate increases in order to continue to effectively manage inflation. Let's look at, however, the next one thing that's a thing correlated with a housing market. So contrary to appearances, the housing market may also indicate potential increases or decreases in the cryptocurrency market, especially in the medium and long term. Indirectly and in a rather roundabout way, the greater the housing demand, the greater appetite for investing in risky assets. That's why investors have excessive cash to spend it somewhere. According to forecasts outlined by the transparent blue spectrum, as you can see right here, the leading indicator illustrating the condition of the housing market should drop in the first quarter of 2024, which may provide a negative benchmark for the decentralized asset sector indirectly in the coming 2 quarters. Positive aspect is the fact that building permits should increase from the beginning of 2024, which should therefore coincide with a positive period for more risky markets. The second quarter is also a period deeply awaited by cryptocurrency enthusiasts. During this period, there is a high probability of acceptance of Bitcoin ETFs, about which the industry is deeply enthusiastic. Analogizing the launch of spot ETFs for gold in 2003, for which this procedure turned out to be an indirect catalyst for growth. And having all that being said, let's look at the new home sales and ISM Purchasing Managers Index. The quality of photos is a bit lower, sorry for that, it just was a conversion type of a error, but hopefully you get the trajectory. That's the most important thing. Despite the increase in home sales in the United States in the first 2 quarters of 2023, forecasters currently estimate that due to the deterioration of consumer sentiment, the next quarters will be marked by discounts. And although this indicator also bears the hallmarks of a factor leading the economy compared to the first 2 mentioned in the previous type of slides, it shouldn't have a major impact on sentiment. However, the PMI index may be more important. Purchasing Managers Index is an indicator used to assess the economic situation in the production sector. An increase in the PMI value may mean an increase in production in the manufacturing sector, and a decrease in the PMI value may mean a decrease. And it's these periods of increases and subsequent declines that have a significant impact on the behavior of the cryptocurrency market, which is visible by correlating the total capitalization of the crypto market that's right now pointed right here, and that's the correlating the total capitalization of the crypto market and the boom and bust periods for PMI. And in 2021, when we saw astronomically inflated cryptocurrency valuations, we also had the opportunity to record some of the highest PMI values in the last several decades, literally. So will it be possible to achieve equally sky-high increases in cryptocurrencies without stimulating the markets with an excessive but also artificial supply of cash by the Federal Reserve Office? Time will tell anyway. And we have got to the time of more sentiment type of indicators, consumer sentiment. Let's look at this, what it has correlation with decentralized finance. So the consumer sentiment is a factor that indicates the future development of consumption and savings of households based on answers regarding the expected financial situation, and also is expected to record a significant decline as a result of high interest rates and a very restrictive loan granting procedure. That's the forecast. So right now we're still revolving around this kind of neutral levels, but the forecast is getting more deteriorating. Consumers perceive that the rapid economic improvement over the past 3 months has moderated, especially due to inflation, and are uncertain about future prospects. So that may weigh eventually on the valuations of crypto. Right here you can find United States factory orders and average weekly hours. So what it has to do with crypto. After a period of turbulence, US order rates should normalize in the second half of 2023 and in 2024. That's the forecast, alright? We are fresh from the end of the crisis related to broken supply chains, so volatility should no longer be as unstable as in the last 2 years. Therefore, the predictive analysis of this factor shouldn't cause any impact on the valuation of assets from both the regulated and decentralized markets. The average value of working hours, however, may be used to determine the condition of the labor market. It's currently assumed that this value will increase, so the condition of the employees market may have eventually a positive outlook for the economy, but negative impact on maintaining increased liability in terms of inflation levels. And from that point we are jumping to crypto versus jobs outlook. So this was average weekly hours and right now non-farm payrolls and personal spending. Look at this. By end of the year, there are forecasts that the labor market will deteriorate in terms of the number of employees. We have now experienced the third consecutive month in which the number of jobs fell below 200,000 threshold, indicating a gradual easing in labor market conditions, largely attributable to significant interest rate increases by the Federal Reserve intended to cool inflation. The deterioration of indicators in this area may also be the result of the intensifying wave of implementation of solutions related to artificial intelligence, of course. We have already heard about the growing number of filmmakers and lawyers in the professional group who were to lose their jobs en masse as a result of newly developed solutions based on based linguistic and graphic models. There are indications that for this reason several 100,000 people may lose their jobs in the banking sector in the United States alone in the next few years. At the moment, however, it's difficult to relate such trends to market behavior. One thing, however, is certain. If the productivity of economies increases thanks to new technology, the employment rate will no longer determine the condition of a given market. So the personal spending index, in turn, as a result of declining consumer sentiment, should also decline in the second half of this year, which should also weigh on falling valuations of risky assets such as crypto. So typically this is the outlook that right now is not favoring such of a type of a being too risk and too exposed to that already high valuations on the markets. Not talking about maybe the crypto, as right now is the laggard behind the US 100, but still that's something that may push back a bit eager type of investment decisions that right now have been pushing the valuations throughout second quarter. So third and fourth quarter, maybe the fourth will be this a little bit pushback type, but the fourth one is expected to boom as that's normally the best time on the market to get a great returns on investments. Alright, but without any further ado, let's get to next, and that's very interesting, CPI and GDP growth rate. So that's absolutely something we need to study, and let's look at this like that. Despite this disinflationary trend in the United States, we are dealing with constantly increasing product prices. That's what is observed right here on this matrix. Although the dynamics of these increases is decreasing, there is no indication of the arrival of a period of deflation that could restore previous price values. So we are all talking about the AI that will bring this deflationary wave, but it's still very, very far from this in order to observe it. A negative aspect of the inflation spiral may be the higher value of gross domestic product than previously thought. So it's overall positive for the economy, but not in the type of the higher type of inflation. The Atlanta Fed estimates an increase in this factor even above 4% from quarter to quarter, which proves that analysts are convinced of the strong demand that would appear then. And it's time to wrap up, so let's take all of this what I've just said. So third quarter, I would expect that will end up a bit negative for crypto as it's right now, and normally seasonally not the best time to invest in any type of financial asset, but fourth quarter, as it's statistically the best quarter to in terms of return on invested capital. I do expect that will be much more positive. That will be the rebound quarter, and it will maintain this moderate positive sentiment by the the first quarter and second quarter of 2024. And the largest catalyst will come over after halving of Bitcoin. That seasonally is the best time to invest in crypto. But if you do wanna know what to do in the times like this and the time that may come, I highly recommend you to watch Best Crypto to Invest in on the channel of Wall Street Station. That was the live transmission, so we may find it in the top of live on the YouTube channel. And that's it from me. Thank you very much for sticking around. If you have any questions, just put it in the comments section below the video, and have a great weekend.